President Biden's American Family Plan proposal has some interesting opportunities for small business owners. And here to talk with me about that is Robert Klein from the Retirement Income Center. Robert, welcome.
Thank you, Bob.
So, what do small business owners need to know about President Biden's proposed plan, which is not yet law, but certainly folks might need to plan in anticipation of it or some form of it becoming the law?
Yeah, that's a loaded question. There's a lot of things in here small business owners and others need to be aware of. It was just released last Wednesday, and the proposal would increase the top marginal tax rate from 37% to 39.6%. And how this really affects small business owners and other people with unrealized capital gains, whether it be real estate or stock portfolios, it would apply the top 39.6% rate to long-term capital gains for individuals with income in excess of $1 million. So it would literally replace the 20% long-term capital gains tax rate for these individuals that we've been enjoying for the last several years.
Right. So there's some actions that small business owners and others might consider as a way to maybe dampen the effect of this potential increase?
There are. Before I get to it, I just want to expand upon this a little bit as far as what the true impact would be. The long-term capital gains rate would almost double, going from 23.8% to 43.4% when you factor in the net investment income tax of 3.8%. So the increase would be 19.6%. And then on top of that, you need to add in your state taxes, which could be as high as 13.3% where I live in California. So you're looking at a marginal tax rate of 56.7% on long-term capital gains if your income is in excess of $1 million. The other thing is it's not just a lifetime proposition. The legislation would eliminate the step up in basis on unrealized gains exceeding $1 million at death. So you'd have the same 43.4% tax rate that would apply to unrealized gains. So to your point, there is a big strategy that can be implemented by small business owners, which has been blessed by the IRS and has been in place for a long time, referred to as a Charitable Remainder Trust, or CRT. Many savvy business owners have exploited this strategy, have used it to obtain the first benefit from the CRT, first and perhaps most important benefit, which is the elimination of the capital gains that you incur on the sale of a business. Although it's favorable, today you still want to avoid taxation, and one way to do that is to start a CRT, and that would avoid the capital gain.
Right. So do you want to walk us through the mechanics of setting one up and how it works?
Yeah, basically, it doesn't have to be an all or nothing situation. If you're selling a business, you can you have to set up a charitable remainder trust document, and a state attorney who specializes in CRTs is the one to go to for that. And then once that's done, you would carve up your ownership of your business, assuming you own it 100% personally. You need to analyze and decide how much of that is going to be gifted to the CRT. And as such, when the business is sold, the portion that's gifted will avoid taxation on the gain that you're going to incur.
So in terms of so for some folks who are, I guess, thinking about selling their business, this is one way to do it instead of, say, selling it immediately.
Correct. Instead of selling it outright yourself, this basically eliminates the capital gain on the sale. And to the extent it's in the CRT, there is several other benefits associated with this. Another tax benefit is a large charitable contribution deduction, because the CRT will ultimately, the remainder of the CRT will go to one or more chosen charities, the IRS allows a charitable tax deduction, which is equal to the present value of the remainder interest that the charities will get. And so this turns out to be quite a sizable deduction, depending upon the value of the business and the age of the business owner and his or her spouse if married. But it can be literally hundreds of thousands of dollars or greater. So that's a second big benefit. The charitable contribution deduction, because it's so large, there's a limitation on it. It cannot exceed 30% of adjusted gross income. Any amount over 30% gets carried forward for 5 years.
All right. And there's some estate tax implications as well with using the CRT?
There are. The estate tax, because your charitable remainder trust, the remainder will go to charities, it's exempt from estate tax. And that is a big savings, and it could become a bigger savings because in addition to the tax proposal we're talking about, there's another proposal out there that actually came out in March that would reduce the amount of one's estate that's exempt from estate tax from 11.7 million down to 3.5 million. And furthermore, the proposal includes an increase in the estate tax rate from 40 to 45% for estates over 3.5 million. And then it jumps up to 45% if you go over 10 million. And then if you're one of the fortunate few that has $1 billion estate, you're looking at a 50% tax rate. So a CRT is, with its philanthropic orientation, is a great opportunity to avoid estate taxes at any level.
Right. And then in terms of using the strategy with respect to your retirement income plan, there's some things that folks need to think about with respect to that.
Yeah, that is a key thing, Bob, because a CRT basically, when you're a business owner, you have your salary, of course, but then, a CRT can be used as a mechanism for retirement income. And so specifically to the extent that you transfer part of your business ownership into the CRT, once it's in the CRT, it'll get sold and reinvested, and you're entitled to the income from your CRT. It can be paid out a couple of different ways depending upon the type of the CRT. It could either be a fixed monthly amount or quarterly amount, or it could be a percentage of the assets in the CRT. And so you have a lifetime income stream that you're going to get. And furthermore, that income stream is tax favored as well, because the accounting of the income is such that it looks at the origin of that income. So in the case of a sale of a business, you're taking capital gains that you avoided the tax on, putting that into the CRT. And then, so as you earn your income, a large portion of that income will be taxed at a favorable long-term capital gains rate. And so provided that you keep your income, even if the proposed tax law goes through, even if you keep your income at a level under $1 million, you'll still have that favorable taxation.
So as I read your article, and as I hope our readers read it as well, it occurs to me that there may be many small business owners out there who say, well, I don't have adjusted gross income of $1 million. I draw far less than that. But they've never contemplated perhaps the value of their business and the liquidity event that they might anticipate. And those are the folks for whom I think this strategy, they need to put this on their radar screen and have a discussion with their CPA or estate planning attorney or financial professional as they think about unwinding or their business.
Yeah, and as a matter of fact, it's an opportunity now to think about, if you were contemplating the sale of your business, accelerating that so you can have that transaction take place, hopefully before this legislation or any other form of it is enacted, because tax legislation is often based on the effective date is often the date of an enactment, and sometimes it's a retroactive date. So small business owners really need to take a look at this, a serious look at it. It's not for everybody, but it's definitely worth evaluating. And like you said, Bob, it's easy for a small business owner to have a sale of a business where you have a capital gain in excess of $1 million. So this is not unusual, for a taxpayer to have $1 million in this type of situation.
Yeah. So I want to remind viewers too that if you haven't read the article, do so, because among other things, there are a couple case studies in there where you go into great detail about the use of this technique and strategy.
Yep. Yeah, there's a really good example in there, and it's worth taking a look at.
Yeah. Robert, before we wrap up, anything that we haven't chatted about that you want to make mention of, or anything that you've already chatted about that you just want to reemphasize?
I just want to summarize to say a CRT really is, it's a powerful planning strategy that can be used as the cornerstone of a successful business owner's retirement income plan. Offers the opportunity for sizable initial and ongoing tax savings, sustainable tax-favored lifetime income, elimination of estate tax on CRT assets, and last but not least, and very important, a philanthropic / legacy component, whereby the remainder of the CRT will be distributed to your favorite charities.
Great. Well, as always, Robert, I want to thank you for writing for Retirement Daily and for sharing your knowledge and wisdom with us on these videos.
Thank you, Bob.